The topic that we've gone with today is exploring the next normal for commercial property markets. And I wanted to articulate what that next normal may look like through essentially three questions. These are the sorts of questions that we're getting from investors at the moment in terms of their own thought process to navigate a post-COVID recovery trajectory. And the first of those is, will COVID-19 have a significant impact on office sector demand? The second question that we get a lot of is, what factors are contributing to the resilience of the industrial and logistics sector? And the third question is, how are we interpreting the conditions in the real estate investment market? So let's start with the first question around the outlook for office sector demand. And let's just start by looking at the short-term outlook. And clearly, given the health crisis has manifested into an economic crisis, we have scaled back our net absorption or demand forecasts for 2020 and 2021. What I'm showing you here is actually the shift in forecast that JLL made in January, pre-COVID-19, and then post the announcement from the WHO that COVID-19 was a global pandemic. The numbers that sit above the bars essentially show that shift that we've made in those demand forecasts for 2020 and 21 aggregated. So you can see that we have made some significant downward revisions for office sector demand over the next 24 months. Some of the factors that we're looking towards specifically are the potential for tenant downsizing, an increase in sublease availability, and also as we move into the latter part of the year, the potential that the business failure rate will start to increase. What's going to be really interesting is the level of leasing activity that we see. Typically, in a downturn, we see much lower levels of leasing activity or day-to-day leasing activity. So that tends to say that owners of existing assets actually tend to report higher tenant retention rates during periods of downturn, given the level of uncertainty that some organizations have around their potential future headcount growth. Now, that's the short-term outlook. There are some bigger thematic questions, I think, that need to be explored around the office sector. The first of those is around the whole work-from-home story. We've heard a lot of large organizations, largely US tech firms, come out and give directive to their people in terms of how long they can work from home. Now, JLL has undertaken a global survey of 3,000 people. These people work for multinationals. And we really wanted to understand their work from home experience in terms of how that actually shapes their attitude towards workplace. And when we asked people if they missed the office, 59% of them responded that they did miss the office. Now, this wasn't a binary question. This was actually done on a 10-point scale. And to qualify as being part of that 59%, you had to actually rank an 8 or higher. We also saw a number of people that actually ranked it around 6 or 7, which would increase that overall observation. What's really interesting, though, is when you start to drill through the different demographic cohorts. So we found that people that are less than 35 years old actually miss the office even more. And that, again, points towards the millennials, the Gen Ys, the Gen Zs that are now coming into the workforce, that desire for socialization, that desire for interaction with their colleagues. And when we asked people specifically what they missed about the office, that came through in the results quite strongly. It was really the people that they missed. They missed that human interaction. They missed the collaborative environment that they have within their workplace. And it's actually interesting, they provided a very diverse range of answers in terms of what they ultimately missed. We did ask them about what they enjoyed about working from home, because we think this is really important for organizations to understand moving forward. And the overwhelming response came back that they enjoyed not having a commute. They enjoyed the flexibility, and they enjoyed what they saw as an enhanced work-life balance. So we think that there has to be a greater alignment between the head of people, or HR, the CFO, and then how that flows through their corporate real estate strategy. And we as a house believe that we're going to start to see an evolution of what we call the hub and spoke model, where large organizations actually have multiple locations and they truly understand where their workforce live. They understand where their future workers are likely to live based on demographic trends, and they have multiple locations, whether that be in the CBD or whether that be within certain metro markets. And work from home will become one of those spokes as well. The other thing that I think is really interesting in the whole work from home discussion, and I've certainly seen this through talking to a number of clients, is the whole organizational culture piece. Now, Edgar Sheen is really the main proponent of research around organizational culture. And Edgar Sheen talks about 3 layers of culture. He talks about the artifacts or the visual elements of culture. He talks about the espoused values of the organization. And you can think of the words that a lot of companies use. They talk about collaboration, they talk about teamwork, they talk about customer obsession or customer centricity in terms of some of their values. And then you've got the deepest layer of culture. And to me, that's the most interesting part of culture. And it's what Sheen termed basic assumptions. And I think it's interesting when you have organizations that talk about the collaboration, ultimately that customer centricity, having the collaboration to create new products and new ideas and new services for their clients. And to me, that's the key role that Workplace has. Workplace brings people together and allows that collaboration, that interaction between them, and that's how new ideas are generated. So while we can certainly, we're probably all better now in terms of using technology, I still believe that Workplace has a very strong and important role in terms of ideas generation moving forward. So how do we expect to see the market recover from a numbers perspective? And what we've got here is essentially looking at net absorption cycles going back to previous downturns, going back to the early 80s recession. And in terms of interpreting this graphic, year 0 is the bottom of the market. Year 0, as I said, is typically when you have an increase in sublease, tenant downsizing, business failure rate. And as we said earlier, we've already revised down our numbers for 2020 as a result. 21, or year 1 on this, tends to be the first phase of normalization. And then you tend to get a recovery in year 2 and year 3. If you look at the dotted black line, we're being fairly conservative around what that recovery looks like. And we're actually below the recoveries that we saw in the 80s recession, the 90s recession, and ultimately the post-2000 slowdown. I think what's really interesting when I look at this chart is that the economic ingredients of every downturn are always very different, but the way the office market behaves has been remarkably consistent. And if you think back to that post-2000 period when we had those horrific events in New York City with the planes going into the Twin Towers, there's a lot of people were saying at the time that companies, individuals are not going to want to work in high-rise towers. You can count that there's a very large number of high-rise buildings that have obviously been built that are higher than the World Trade Center since that time period. And even going back to the early 90s, I was speaking to my predecessor and he was saying, with the launch of the World Wide Web, there was the view that people didn't need to use Workplace or use office space the same way as they did. So we've had these discussions before. I don't want to come across as almost sounding flippant about it because I do think there will be some interesting changes. But I may borrow John Baptiste Alphonse Cata's phrase, and he talked about the more things change, the more things stay the same. And he said it in French, and he said it in a better accent than what I've just said. But I do think it's interesting. There will be some cyclical and structural changes. But if you look at the place that Workplace has, we still think that has an important role for organizations due to the culture piece. I want to then start to think about some of the sectors that we're looking at. And this is where we do expect to see some structural changes in terms of the composition of tenant demand moving forward. So I've identified 6 industry sectors or industry subsectors that we're watching very closely. Right in the middle of the screen there is the digital economy. I think it's interesting when we look at technology firms, the NASDAQ's just come back a little bit, but the NASDAQ had already reached its pre-crisis peak last week and is obviously trading at a very high level. We're probably less interested in those NASDAQ-listed companies because a lot of them already have representation in Australia, but it's that next wave that's coming through. And we're having discussions with a lot of the venture capital funds based out of the US and the West Coast in particular, and they're looking to identify those next organizations that are going to have an impact. It's quite intentional that I've got health and public administration either side of the digital economy, because to me, there's actually quite strong linkages in terms of how we're seeing it at the moment. If you looked back in the budget papers of last year, you would have seen that the Department of Defense was a strong growth area for the Commonwealth, and cybersecurity was one of those areas where they were seeing strong growth. What we've seen over the last 12 weeks is a real acceleration in the number of cyber attacks on public entities and also on private sector organisations. So we continue to see that as a growth area for the Commonwealth of Australia around that broader cyber piece and how that plays into tech and the digital economy. Then on the right, we've got health. Now, coming out of a health crisis, we expect to see an acceleration of the take-up of space from healthcare-related companies. We were actually talking about this pre-COVID, and if you look at the US in 2018 and 2019, healthcare was the fourth largest industry sector contributing to US leasing activity. In Australia, it was about seventh or eighth. So we were expecting to see more activity from this sector, but as I said, coming out of a health crisis, that will accelerate. The other thing I think that's interesting is this concept of health tech, which is around the creation of vaccinations and other healthcare-related products. We already see clusters of those sorts of industries based in areas like Kendall Square in Cambridge, Massachusetts, and we expect to see a greater evolution of that clustering of the healthcare and related sector in Australia moving forward. Looking at the bottom row, you've got some what I'd call probably more obvious candidates. Right in the middle there, we've got mining. The iron ore price went up to 103 US dollars a ton last night. We know that that's partly due to some disruption that we've seen in Brazil in terms of supply. But I do believe a lot of economies around the world will be focused on infrastructure spending in terms of re-accelerating that reopening of the economy. So that should be positive for the export of iron ore. And then on the other side, we've got supply chain management. I think that's going to be a really interesting area to watch. We tend to think about more in the context of retail and industrial and logistics. But when I look at the type of professionals that they are going to be involved in supply chain management, I can't really see them sitting in warehouses out in Western Melbourne and Western Sydney. They're more likely to be sitting in some form of office accommodation. I'll leave manufacturing to the side because I think that's a relevant discussion when we get into industrial and logistics. So as I said, that second question that we're getting a lot of is, why is that sector being so resilient? And there's really 3 or 4 areas that you can point to that support that resilience. E-commerce probably captures too much attention in the overall sector relative to its footprint, but it clearly is a growth sector of industrial and logistics moving forward. If you look at Australia's pre-COVID e-commerce penetration rate, it was sitting at 9.3%. On the NAB numbers, that's already jumped up to 9.6. The global average is around 11.9, and the US and the UK are even higher. It was quite interesting pre-COVID. We heard a lot of barriers as to why Australia was different. The dispersed population, the high unit labour cost. I often think it's actually some of the more simplistic barriers, and it's been interesting how the health crisis has ultimately removed those. And one of those is every time you ordered something, you had to sign for it. Now with the health crisis and social distancing, we have contactless delivery. So for those of us that live in detached dwellings, we get the doorbell pressed, the product's there, and we've not actually signed for anything. So something as simple as that is actually part of the contributor that accelerates this story. Food retailing, we think, is a really interesting one to watch. It's only 3.5% in terms of the e-commerce penetration rate. And again, that's another area we see an acceleration. Manufacturing, 6% or roughly 6% of the overall Australian economy. I'm not a big subscriber to the onshoring of manufacturing activities, but I do see the manufacture of product, whether that be pharmaceuticals, whether that be the hardware within healthcare, is certainly going to be a growth area of manufacturing moving forward. In the bottom left, we've put the lean inventory model. A lot of organizations move towards just-in-time supply chains. That's been happening over a longer period of time. Some of those supply chains have been challenged. We don't expect to see a significant increase in the amount of inventory that they ultimately hold, given the costs associated with that. But we do see some organizations moving slowly away from that lean inventory model. The risk factor that we see for the industrial and logistics sector, which I think is relevant when you think of commercial property more broadly, is around population growth and the scale back that we've seen in population growth projections over the next few years. If you look at industrial and logistics specifically, for every headcount, every person we add in Australia, we need 4.5 square meters of industrial floor space. So obviously that's going to lead to less asset creation in the shorter term. The other big evolution that we need to think about in the sector is what's happening around warehouse automation. And while we get very fixated on what Coles and Woolworths and Coca-Cola Amatil have been able to achieve, to me, a lot more organizations are thinking of parts of automation rather than the type of implementation that we've seen from those groups. So essentially, asset managers really understand their organizations that occupy their space by allocating the automation that they're doing to one of these 5 factors. And I think it's important to understand that because you really start to truly understand the underlying business of that particular organization. We also see the evolution of the sector more broadly. Cold storage, we would argue, has been a niche part of industrial and logistics. We see potential growth there moving forward. The image on the top right relates to data centers. I think we will see an acceleration of investor interest and demand for data centers as well. And then you've got some more of the minor players that are starting to think around that micro-fulfillment piece. So Takeoff that have partnered with Woolworths, ultimately to look to do that micro-fulfillment from the existing store network. And the one on the bottom right there is a group called Starship Robotics, who are using droid technology to ultimately do micro-fulfillment within a 2 to 3 kilometer radius. Now, I just want to touch on retail quickly, because really retail, and in particular discretionary retail, is where we've seen the greatest challenges coming through COVID-19. A lot of these challenges were evident prior to COVID, and some of these challenges have now been accelerated as we're going through the health crisis. So I won't intend to go through every single phrase on this chart. We could probably spend the next 48 hours dissecting this, but there's a few interesting ones that are coming through around sustainable rent reset. We're now starting to see that within the larger shopping centres. Store rationalisation. But the one that really interests me sits a little further down, and it's called changing yield hierarchy. And we've historically seen a very clear hierarchy in terms of tighter cap rates applied to the larger shopping centres, followed by the mid-sized shopping centres that are reliant on DDSs, and then convenience retail and large format retail. I think one of the things to watch moving forward is, will we see a change in that hierarchy? Because those convenience centres through COVID have managed to have very high rent collection rates. Those larger centres have actually seen very low rent collection rates. So we may see a reassessment in the confidence in the cash flow and the risk premium that is ultimately applied to different retail categories. So the last part, and I'll go through this very quickly, is around what we're seeing in the investment markets. And the first of those questions is, how quickly will transaction volumes rebound? Now, we don't think looking back at 2008 is really a good guide in terms of the overall activity, but there is one key message which I think is relevant, and it's looking at global equity markets. And I've used the S&P 500 as a guide here. After the correction in 2008, it took until April 2013 for it to recapture its pre-crisis peak. That was almost the same journey that we saw for commercial property transaction volumes. So the denominator effect over that time period was very real for pension funds, that it saw a significant correction in the value of their equities holdings and were ultimately overweight real assets. Then we've got the scenario this time around. We saw the big crash in equity markets in March. We had a very strong recovery. It was a little bumpy last week, but given that unprecedented policy support, it has provided some support to equities. And we now see the potential, notwithstanding any risk around reinfection, that equity markets recover and we see a shorter pathway back towards pre-peak transaction volumes. Not so much for 2020 or 21, but looking at 22 and 23. So one of the things I think that's really interesting is looking at property market discount rates tracked against the 10-year bond yield. And I'm using discount rates here as a proxy for return. And you can see when you look at this chart, there's a very strong visual correlation. Industrial and logistics and office has shown a correlation coefficient of 0.88 and 0.85 over that time period. The spread that we see at the moment is wider than historical benchmarks. And that's partly investors factoring in a partial mean reversion in the risk-free rate, but also the application of a higher risk premium given some of the uncertainty. It's actually interesting, and we're a big subscriber to Nikki's Business Outlook that they publish, and we've been looking at the 10-year bond yield forecast moving forward. And the average over the next decade, and the spot figure 10 years from now, is around 30 to 40 points lower. So given that's the risk-free rate when we start to think about real estate returns, once we see a normalization in the risk premium, that ultimately supports that environment around lower investment returns. Now, just very quickly, and this will take a long time to go through, so I won't do it. Essentially, what we're looking at here is potential growth within sectors and institutional interest. If you look at where industrial and office is sitting at the moment, we believe they're portfolio cornerstones. And you can see that institutional interest, which is illustrated by the x-axis, is very strong. It's strongest in industrial and logistics at the moment. We continue to see strong interest for CBD office, but the one to watch moving forward is very much going to be metropolitan office as we see an evolution in this hub and spoke. So they were the three questions that I had. You obviously get the material post this, but that's really the answers in terms of how we saw those three questions. So I want to thank everyone for listening and hand back to Steve in the studio.
Thank you for that, Andrew. Look, I want to apologise in advance. We've almost 500 attendees at this event. It's simply not possible to get through the questions. So for our external speakers, I'm only going to be able to ask a question, and you will see at the end of today's slides the contact details of Charter Hall. So I would encourage you to reach out, and anything that isn't answered today, please do ask us. So we've got a question here from Sally, Andrew. It says, Andrew, how do you reconcile workplace collaboration with a hub and spoke model where you have employees in different locations?
I think that's a really good question, Steve. I mean, ultimately, when we look at the hub and spoke model, we're not saying 5, 6 locations. It's really around more that 2 locations and then work from home forms part of the spoke as well. So I think it's that mix. I think for organizations, they're trying to find a utopia or some form of nirvana where they can actually get the balance right between flexibility for their people and collaboration. So I think it really depends on ultimately the size of organization, the type of activities they undertake. We don't think hub and spoke is relevant for a number of organizations. We do, as I said, think you have to be of a certain scale. And I think that's ultimately going to be what we see the consultants to those organizations is trying to navigate a pathway towards getting that balance right between flexibility for people. Often we hear the flexibility is flexibility on their terms, and actually that the workplace strategy that goes around it. So it's going to be a really interesting area moving forward, Steve.
Fantastic. And look, thank you for those additional insights as well.